Breaking news from Europe this morning. While the world reacts to the shocking release of 3 million Epstein files naming Bill Gates, Elon Musk, and Donald Trump, silver prices are staging a dramatic recovery to $85 per ounce. That's $80 for European investors. Just days after a catastrophic 37% crash from $121, markets are in turmoil as 50 powerful figures are exposed in the DOJ document dump. Is this silver rebound real, or are the Epstein revelations creating a distraction? Let's break down what Europe needs to know right now. Johan here. If you're watching this right now, I want you to pause for a second and understand what kind of day this is in markets, because days like this don't just move prices, they expose the wiring behind the whole system. The Epstein files headline hit like a flash grenade. Not because markets care about scandal in a moral sense. Markets don't have morals. Markets care about trust, leverage, and who gets forced to liquidate when confidence fractures. And when you combine a politically radioactive headline with already fragile positioning after a metals crash, you get exactly what we saw: chaos in risk assets. A scramble for liquidity, and then that weird, almost insulting bounce. Silver rebounding toward the mid-80s, while the broader metals narrative still feels broken. Let's walk through it the way professionals do, not the way Twitter does. When the phrase files hits the tape, the first thing that happens is not price movement. The first thing that happens is uncertainty. And uncertainty creates a spread. It widens spreads in credit. It widens spreads in equity volatility. It widens the gap between what people think something is worth and what they are willing to pay for it right now with real money. That matters because modern markets are not primarily investors. They're balance sheets, they're collateral chains, they're margin, they're rehypothecation. They're algorithms measuring volatility and reducing exposure when volatility rises. A scandal headline that threatens institutions, reputations, or political stability doesn't have to be proven in court that day to move markets. It only has to be plausible enough to create de-risking. And this one wasn't just a headline. The way it spread, rapid, emotionally loaded, claims about dozens of names, claims about Europe reacting, claims about government scrambling, claims about markets rocked, that has a specific signature. It triggers what I call narrative volatility. It's not fundamental volatility like a supply shock or a rate decision. It's a trust shock. And trust shocks always do the same thing. They force the system to choose between holding risk and holding liquidity. Now you might be thinking, okay, what does that have to do with silver? Silver is supposed to be a safe haven, right? Here's the trap. Silver is not gold. Silver is part safe haven, part industrial metal, and part leveraged trade vehicle because of how it's used in futures and CFDs. That means in the first phase of a panic, silver can behave like risk. It gets sold, especially if people are long on leverage. If you're a fund and you get hit with redemptions, you don't sell what you want to sell, you sell what you can sell. You sell the liquid stuff. You sell futures. You sell ETFs. You sell what has a bid. That's why you can see a day where a scandal headline hits and the first move is actually down in metals or chaotic in metals. It isn't because the safe haven thesis is wrong. It's because the market is deleveraging and grabbing dollars, not grabbing metal. That's phase one. Phase two is where things get interesting. Phase two is where the market stops selling everything and starts discriminating. That's when the narrative shifts from sell risk, raise cash to, okay, what's the longer term implication? If trust is damaged, if institutions are being questioned, if political stability is threatened, then long duration trust assets start getting bid again. Gold, high quality bonds, depending on the context. And yes, silver, especially if the physical market is tight. So when you saw silver rebound toward $85 after being smashed earlier, that's not the market forgiving anything. That's the market moving from forced liquidation to positioning. It's the difference between panic selling and intentional buying. Now let's talk about the Europe reacts part. Because Europe is always the canary when it comes to political risk turning into financial risk. Europe has a different sensitivity profile than the US. The US can absorb scandal into the news cycle like a machine. Europe tends to translate political uncertainty into institutional uncertainty faster, especially when it intersects with banks, regulatory bodies, or cross-border implications. When Europe reacts in markets, you often see it first in currency and credit, not in stock headlines. You see it in the euro wobbling. You see it in bank equities underperforming. You see it in volatility pricing. You see it in flows into defensives. And importantly, you see it in how commodities are treated, because commodities are global and Europe is highly exposed to energy and industrial inputs. So if the European session opens after a US-driven headline shock and European desks decide the story increases uncertainty, you can get a risk-off pulse, even if the US is trying to stabilize. That risk-off pulse can hit industrial metals. It can hit miners. It can hit silver because silver has that industrial component. And then you get a dislocation, paper price selling, while physical demand quietly doesn't care. This is why scandal-driven risk-off days are dangerous for paper silver shorts. Because they can push price down in the paper market through forced liquidation, yes. But if that same day pushes more people toward physical ownership, especially outside the US financial system, then the physical market tightens. Premiums expand. And eventually, the paper market has to reconcile with that reality unless it changes the rules. Now, I am going to address the JP Morgan angle carefully because I'm not going to do fantasy leaks. I am going to talk about how the market uses leaks, regardless of whether they are real. When people say JP Morgan leaked a target, what they're really talking about is the psychological weaponization of authority. A bank's name is used as a narrative amplifier. It doesn't even have to be a real document for it to move retail sentiment. It just has to be believable enough that people repeat it. That repetition creates reflexive behavior. Traders sell because they think others will sell. Dealers widen spreads because they anticipate volatility. Funds hedge more aggressively because they see headline risk. So whether or not any specific bank leaked anything, the functional effect is the same. Authority-based fear becomes a liquidity event. And that matters because silver is uniquely sensitive to liquidity events due to how leveraged the paper participation is. A lot of silver exposure is not, I bought a bar and put it away. It's futures, CFDs, leveraged ETFs, options. Those instruments are margin sensitive. A volatility spike triggers margin changes. Margin changes trigger forced selling. Forced selling creates the crash people point to as proof of bearish fundamentals. It's circular. Now, let us connect that to what we already know from broader market coverage about the recent metal sell-off. Multiple outlets have attributed the sharp drop in precious metals to a strengthening US dollar and investor reaction to President Trump. S-Fed pick Kevin Warsh with silver, noted as having fallen roughly 30% from an all-time peak, above 120 to around the low 80s in that episode. Source. Another report similarly described silver plunging more than 30% and linked it to the stronger dollar and the reaction to the Fed pick, while quoting an analyst, warning of potential further downside. Source. Why am I bringing that up in a video about the Epstein files rocking markets? Because it has the same mechanism: credibility shock, dollar reaction, volatility spike, deleveraging, metals get hit. The initial move is not safe haven, it's cash. Then later, after the forced liquidations, you get the rebound. That's exactly why today's silver bounce matters. It tells you the forced liquidation phase may be waning, at least temporarily. And Europe? We have commentary out of European market coverage that describes a recovery in precious metals, with silver up around 10% in a rebound move, noting that whether silver can reclaim higher levels depends on things like retail demand and ETF demand, and highlighting that ETF flows had shrunk and holdings were reduced in that period. Source that. That's important because it tells you Europe is looking at the rebound not as a story, but as a flow problem. Who is buying, who is forced to sell, and which channel, retail, ETF, industrial, dominates next? Now, let's make this practical. You are watching silver rebound to 85s, and you want to know, is this a fake bounce or a historic buy signal? The honest answer is, you can't know from price alone. You need confirmation signals. The first is whether the rebound is happening on improving liquidity or just short covering. Short covering rallies are sharp but fragile. They happen when shorts take profits after a crash. They can fade quickly. A real reversal has follow-through. Higher highs, higher lows, and most importantly, it survives bad headlines. The second signal is whether volatility is calming. If implied volatility remains elevated, margins stay high, and leveraged players remain under stress. That creates the conditions for another sudden flush, even in an uptrend. The third signal is the physical paper spread. If paper price rebounds but physical premiums stay elevated, that's bullish long-term, because it suggests real demand is firm even when paper is volatile. If paper rebounds and premiums collapse, that suggests the physical tightness narrative was exaggerated. The fourth signal is ETF flows. I'm not saying ETFs are the truth, but they're a liquidity channel. When ETF holdings bleed, it often pressures price. When inflows return, they amplify rebounds. European commentary is explicitly pointing to ETF demand as a key factor. Source. Now, let's go back to the Epstein headline, because this is where the emotional part of the story tries to hijack your trading brain. 50 names exposed, markets rocked, Europe reacts. Here's what I want you to do. Separate moral reaction from portfolio reaction. You can have a moral reaction, fine, but your portfolio doesn't care about your emotions. Your portfolio cares about whether this headline changes liquidity, rates, currency, and policy. If the scandal escalates politically, you can see a few pathways. One pathway is increased polarization and policy unpredictability. That tends to weaken confidence, increase volatility, and push more demand into hard assets over time. Another pathway is an immediate, violent risk-off move where everything gets sold for dollars. In that case, silver can drop again before it rises, because silver gets caught in the liquidity vacuum. Another pathway is nothing burger. The story burns hot for 48 hours, then gets replaced by something else, and markets mean revert. In that scenario, the silver rebound is more about the prior metals crash flushing leverage than about the scandal itself. So the question isn't, is the scandal real? The question is, does it have persistence, and does it affect institutions? Now, let's talk about why metals can crash even when the world feels unstable, because that confuses a lot of people and it creates bad decision-making. Metals are not a one-button hedge. They're traded in a financial system that uses metals as collateral and as a risk on risk-off proxy. In a true crisis, metals can be sold to meet margin calls. That's why in 2008, gold initially fell. In March 2020, gold initially fell, not because it wasn't valuable, but because it was liquid. Silver is even more vulnerable to that because it's smaller, thinner, and more leveraged. It's also used industrially, which ties it to growth expectations. So if Europe reacts by pricing slower growth, silver can get hit as an industrial metal. If the US reacts by pricing more volatility and more dollar demand, silver can get hit as a liquidity asset. And then later, if the dust settles and people start thinking about trust and inflation and currency debasement, silver gets bid again as a hard asset. That's why you get whiplash. So what's the trade here? I'm not telling you to trade. I'm telling you to think. If you're a long-term physical holder, days like this are not about the screen price. They're about availability and premiums. If premiums are rising even as the paper price is bouncing, that tells you something. The physical market is not relaxed. If you're a futures trader, days like this are about margin and volatility. If the system is forcing deleveraging, you either reduce size or you're going to be reduced by the market. If you're in miners, days like this are about correlation. Miners can get wrecked in risk-off even when metals are stable because miners are equities. They're part of the sell everything basket during stress. Now, let me close this by connecting the dots clearly. The Epstein files headline is a credibility shock. Credibility shocks raise uncertainty. Uncertainty drives de-risking. De-risking drives liquidity demand. Liquidity demand often strengthens the dollar. A stronger dollar plus volatility can crush metals short term, especially silver, especially on leverage. We have already seen precious metals tumble in the context of dollar strength and political central bank narrative shifts in recent coverage. Source. We've also seen silver described as plunging more than 30% and analysts warning of more pain amid those dynamics. Source. Then the rebound happens when forced sellers are exhausted and positioning returns. European market commentary has explicitly framed the rebound in metals as dependent on retail and ETF demand and noted recent weakness in ETF flows. Source. That means the next move depends on flows, not on feelings. So here's the key question you should be asking right now. Is this headline a one-day shock that triggers another flush? Or is it the beginning of a longer trust erosion cycle that ultimately supports hard assets? If it's the first, silver could get sold again before it goes higher. If it's the second, then every forced crash becomes a transfer of metal from weak hands to strong hands. I'll tell you what I'm watching next. Does silver hold above the mid-80s when the next negative headline hits? Do physical premiums stay elevated? Do ETF flows stabilize? Does the dollar roll over or keep strengthening? Does Europe's risk sentiment stabilize or does it continue to price in institutional stress? If you want the unfiltered way to handle this, don a tea, let the scandal headline hypnotize you. Use it as a lens to read liquidity. And remember, the market's first reaction to fear is not buy safety. The market's first reaction to fear is raise cash. The safety trade often comes second. Drop a comment with one word, physical, if you're stacking bar sue. In coins, paper, if you're trading futures, ETFs, or miners, if you're in equities. And if you want, tell me what you want me to cover next. Shanghai Premium, COMEX inventory, or Europe's ETF flows. Johan out.